Hello, it's Jeffrey Christian of CPM Group. It's about 20 minutes after 12 noon here in New York on 10/10/25, October 10th. I want to talk about the fact that gold and silver prices are at record levels and platinum and palladium prices have risen very sharply. We'll be doing a market alert for our clients later today, discussing some of the topics here in greater detail. But basically, gold has reached $4,000. It reached well over $4,000 over the course of this week. A little while ago, while we were preparing this presentation, it was $3,998, down a little bit from earlier in the day. We have seen strength in gold and silver and platinum and palladium. One of the questions that we've been asked a lot this week is this the peak? How do we know when the peak might come? Prices did fall sharply yesterday, but they come back today. Is this the peak, or is there the potential for a sell-off on a short-term basis? When will we know when it's the peak? And the key to determining probabilities for the next moves in metals prices is to understand what's driven the prices so sharply higher over the past week and over the past few months. We saw the price rise from January into April. That partly reflected the change in the U.S. government and increased risks to the economy and the political system, increased hostilities on a societal level, increased violence on a global and on a domestic level. Prices then pretty much moved sideways from April through August, and they began rising in late August and have continued to rise now. Our expectation, our analysis is that gold and silver prices have been rising primarily because of investment demand, and that investment demand has been driven primarily by increased risks and uncertainties globally, domestically, locally, politically, economically, socially, financial market stability. There's a tremendous amount of risk and uncertainty. I have said repeatedly that the risks that the world is facing are higher at this point than at any time since December 1941. That is true. And it continues to be true. And if you want to talk about, well, what is going to cause prices to stop rising, you have to understand what's caused prices to rise. It's investment demand driven by those political, economic, financial, and social risks and anxieties. For the prices to stop rising, those risks, uncertainties, and anxieties have to be reduced. If you think that the trends that we've seen that have driven gold prices higher really since, over the last month or two, and over the last year, and over the last period of time since they started rising in 2019, and really since 2000, when the price was $270 an ounce. If you think those trends are going to reverse, then you might say that the gold price could peak. If you think that these problems and issues are going to continue, you're going to expect investors to continue to buy gold, and you're going to expect gold prices to continue to rise. That is CPM Group's primary outlook, both on a short-term and a long-term basis. Now, we are issuing a market alert on a short-term basis, as I said, later today, most likely, perhaps early next week. And we also are working on finishing up our third quarter long-term economic projections, gold projections, and silver projections, long-term supply, demand, and price under three different scenarios report. We had hoped to have that finished 2 weeks ago, but the markets and other factors have delayed our finishing that work. But that's what 3-day weekends are for, I guess. So that's where we are in that process. We expect the prices to continue to rise. Yes, there might be short-term pullbacks. We think that they'll be relatively shallow because there are a lot of investors who want to continue to buy. So that's our gold outlook. It's also our silver outlook. And silver prices have risen. They're actually at record levels now. The price this morning was $48.07. We're up sharply from about $22 at the start of last year. And similar to gold, we saw the price start to rise really in April, May, broke out of that sideways range that we were in for about 6 months in May and has continued to rise ever since then. I mentioned that silver has reached a new record. People keep talking about $50 silver yes, silver reached $50 in 1980. Silver reached $50 again in 2011. In reality, silver reached, depending, how you want to look at it, it never quite actually touched $50 in many markets. Silver prices touched an intraday high of $49.82 on the 25th of April in 2011. That was the highest intraday silver price ever recorded at that time, and that was for the May 2011 COMEX silver futures contract, which is what we key off of in these presentations. On October 9th, yesterday, the active December COMEX silver futures contract reached a new record high of $49.96.5, surpassing the April 2011 intraday high. The highest settlement price, which is what we use in our yearbooks and our statistical position table in our precious metals advisory, reached $48.58 back in April 2011. Back in 1980, the highest settlement price in January of 1980 was $48.70. And 2 days ago, the December contract settled at $48.99.4. So a new record high settlement price as well as a new record intraday price. We reached new record silver prices. Platinum and palladium prices have risen very sharply the last couple days. CPM Group is going through our fundamentals. And I want to point out that if you look at the increase in prices over the last week or so, when gold and silver rose very sharply, to understand what was happening, understand this. The prices of gold and silver rose, platinum and palladium, aluminum, copper, stocks, bonds, and even the US dollar all were rising at the same time. It wasn't so much fundamental. The fundamentals play a part, especially investment demand in gold and silver for physical gold and silver, and futures buying investment demand for platinum and palladium. But clearly it was something that transcended the fundamentals of individual commodity markets or the stock market itself. It had to do with the fact that there's more money in the world than ever before, and there's a larger portion of that and a larger volume of that money in cash as opposed to being invested in other assets. So investors around the world are sitting on a tremendous amount of cash. And cash, by the way, as defined economically, includes short-term interest-bearing U.S. Treasuries. I'll show you that in a second. So what we're seeing here is something that transcends gold or silver. The fundamentals are clearly important. And there is concern, there's marketing hype about silver inventories in London declining. to critical levels. Silver inventories in London actually have risen about 78 million ounces since their low in March. In March, they were around 711 million ounces. Now they're about 790 million ounces as the end of September. And then the market, the silver promoters will say, yes, but most of that's allocated to ETFs. And there's only about 134 million ounces or so that's unallocated. That's true. It's also true that you don't need physical silver to trade forwards in London or futures in New York. If you look at the history of the COMEX, you had, since the early 1970s, most of the time, COMEX inventories were around 100 million ounces. But that didn't stop the trading volumes and open interest from being much higher, because the futures are derivatives, and futures traders, generally speaking, don't want physical metal. That physical, having hundreds of millions of ounces of silver in physical vaults isn't essential for the continued operation of futures, forwards, and options markets. Hasn't been the case for the last 60 years. In COMEX inventories are now around 500 million ounces, having risen from around 100 million ounces in 2011. A lot of the silver, that 400 million ounces of silver that has been added to COMEX registered depositories, actually came from London when there was an arbitrage opportunity both in 2020 and again in 2024, early 2025. The ships go both ways. And if London premia over New York got sufficiently high, if the London market really were critically tight, the London price would rise relative to New York, and silver would flow back to London from New York. The fact that the London price is not sufficiently higher than New York to warrant that reversed arbitrage, as the traders would call it, or arbitrage opportunity to move it back to London. The fact that it hasn't done that speaks to the fact that the market itself, or the key market participants in the London market, do not see the lower inventories on an unallocated basis as being something critical, something to pay attention to. We'll probably do a market alert for our clients with greater detail on silver in a week or so, because a lot of people have been asking about this. We finished that report for one of our clients, and we will be distributing a modified version, stripped of client-specific information, probably next week or the week after. Platinum prices have risen. They've risen very sharply. They've surprised us. When we look at the platinum market, we see some fundamental concerns with South African production and some investor concerns about the potential for disruptions of Russian platinum and palladium to the market. But most of what we're seeing is increased futures investment demand. And it's not spilling over to rhodium because there's no futures market. So the rhodium price has risen sharply. And if it were a fundamental increase in automotive demand for PGMs for auto catalysts, you would see higher platinum, palladium, and rhodium prices. The fact that the rhodium price has risen but has severely or significantly lagged the increases in platinum and palladium tell you that this is really a futures market phenomenon in platinum and palladium. Platinum has reached $1,657 this morning. It has reached higher than that earlier in the week. Palladium prices were $1,500 this morning. It also had reached higher levels earlier this week. It seems to be an investment phenomenon. Some of that cash that I was talking about being allocated to gold, silver, platinum, palladium, copper, aluminum, stocks, bonds, dollars, being mobilized. This is a chart of the foreign and international holdings of U.S. federal Treasury debt. And you can see it has continued to rise. It started rising after 2000. It accelerated after the Great Recession and global financial crisis. It kind of plateaued around 2015, 2018, and it's been rising since that time, and it's at record levels. Central banks have been using their treasury holdings, turning it into cash to help finance their governments during a time of economic weakness in most countries. And that's reduced their dollar holdings and their treasury holdings. But private investors who hold their assets overseas outside of the United States, some of them are U.S. investors, continue to add to their treasury holdings more than compensating for foreign government treasury holdings being reduced. They have not lost their appetite for U.S. dollars. And that's been identified both in treasury holdings overseas and the dollar exchange rate, which has been flat to slightly higher in recent weeks. That's all I have for today. We will be having an open question and answer session on Monday, which I just realized is a holiday here in the United States and a holiday in Canada. Happy Thanksgiving Day to all of our clients and listeners in Canada. But we will be having an open Q&A session at 11 o'clock Eastern Standard Time, Daylight Time, I guess it still is, next Monday for our clients to ask questions and hear our answers. You can go to our website, you can buy our yearbooks, you can subscribe to our Precious Metals Advisory, you can get a lot of free reads and free videos there, and you can send us a note at info@cpmgroup.com if you want to talk about ways that we can help you invest in precious metals or other commodities in a more effective, efficient, realistic way. In the meantime, take care of yourself. Take care of the world around you, and try to do something good for the world at large. And I'll talk to you next week.